Hello, Mavericks. How's it going? This is Rob Reinhold. I'm joined by our CEO, Darren Fisher. And let me first off say happy Good Friday, happy Easter, happy Passover, whatever it is you celebrate. Hopefully you have a great weekend. Before we jump into the week ahead, we have to cover March Madness basketball tournament first. We have wrapped up the 8th annual Maverick March Madness tournament. We do 2 sporting events every year. We do March Madness, and then we do NFL fantasy football. So congratulations to one of our options traders, Scott F. Great job. He just earned a $300 Amazon gift card. Second place goes to Mad's Bracket. Now, look, I don't know who you are. So if you took second place, please reach out to me. You've got my email. I don't have any way to see what someone's name is or even an email address behind their screen name. So you got second place, get in contact with me. And third place, we had a tie. We had Tom K., one of our options traders, D. Whitaker, one of our currency traders. So it's nice to see our currency traders making a run here into the March Madness tournament. That's all wrapped up. We'll talk sports again when we get into the fall and fantasy football. Let's start off like we always do. Let's take a look at last week's news. What were the big stories behind last week? What was driving events? Well, inflation. Now, inflation is nothing new. We've seen it, but the markets sold off. Now, we had a nice reversal on Monday. We had a pullback. We got a hammer on Friday. Monday's candle was a nice bullish candle. I know that I took that opportunity to get into more bullish trades. And by Tuesday, it was pretty clear that, okay, that was not the pivot point. And we actually had a pretty nasty Tuesday. We gapped down and sold off. And then really from that point on Tuesday, we gapped up and went down on Wednesday. We went up on Thursday, and then we fell on Friday. And then we had a really nasty 30 minutes at the end of Friday to make us actually lower than we were on Tuesday. But overall, I want to say, again, weak at the first part of the week and then really flat until we tailed off at the close. The reason we tailed off at the close was that the bond just kept going. We had the biggest run in the bond market for over 2 decades last week. It did not stop and consolidate. It did not pull back. We went up another 15 basis points up to 283. Mortgages are now over 5%. So this is putting pressure on several parts of the market. If you take a look inside the financials, anyone that has anything to do with mortgages, they're really suffering. They're really good shorts at the moment and likely to continue to be good shorts. Looking into some of the real estate stuff, stuff like Zillow, Redfin, all that stuff is looking very, very weak. The yield curve is no longer inverted. Now, this is what always kind of bothers me about financial news is that, they pretty much had a special about how the yield curve is inverted and everyone was talking about it. And it's no longer inverted. I didn't hear it once this week. No, look, it's not a great yield curve. It's pretty flat. That makes it tough for banks to make any sort of money in a flat yield curve. But we'll see. We talked about how the last 11 yield curve inversions have predicted the last 3 recessions. So I don't know if I said that joke right, but basically we got 11 signals that recession was imminent. And only 3 times did those actually come true. So when you look at it, you can say, oh my gosh, every single recession had a yield curve inversion that preceded it. That's true, but were there 8 other signals that didn't produce a recession? The answer is yes. So we are still kind of like on the fence of, are we moving into recession? Now look, this is just cocktail talk. At Maverick, we trade the market in front of us. We trade the market as it is right here, right now. It's always fun to talk about the future, but right here, right now, we have pressure. We have pressure from interest rates, and that is hitting the normal suspects of what high interest rates do. Tech, comm services, anything that's high beta, that's speculative, anything that doesn't make a profit right now and relies on borrowing money to pay for its expansion, those stocks are really in trouble here. As you can see, we got the CPI up 8.5%, year over year up 6.5%, and the core excluding food and energy was actually much lower than expected. And the market rallied off this. The market rallied off this for about an hour, maybe an hour and a half. And then it gave it all up because that's still a nasty number. We got PPI that was nasty as well. So we have inflation surging. But we got some other economic reports like retail sales was okay. And that's a pretty good print on retail sales. And we got Empire Manufacturing that was a really good print. The question is, can you have high inflation and high economic growth? The answer is yes. Yes, you can. And this is why we aren't as alarmist as other people talking about, high inflation is going to lead to a massive crash and recession. The economy can continue to do better under this environment. So let's take a look specifically at the markets. We just talked a lot of economics, but let's talk technicals here. So this week, again, Dow down 1%, S&P down 2%, NASDAQ down 3%. This is the story about interest rates. Things that are speculative in nature, that don't make profits, get hurt under rising interest rate environments. Oil had a huge pop, had a nice pop. We got all the way down to $96 a barrel, and it didn't stay there for long. It popped up, and gold went higher. And not just these two commodities, but last week, the commodity trade was really strong. A lot of the materials and energy stocks just took off, and anything to do with food right now is just red hot. Food is hot, agriculture is hot, commodities are hot. Everything's really hot right now in those sectors. But this is where we've been talking about this market being a bifurcated sector. So let's take a look at the S&P. As you can see, we got the gap down here, and we just continued to fall. And as I said, this was the low. We gapped up, we fell down. We gapped up, we gapped down, we ran up. We gapped up a little bit and ran all the way down. Look at these candles. Every single one of those engulfs the other. Well, our call last week was that the market would likely be flat with big up days and big down days. And at the end of the week, it would be basically where it was, a little bit lower. That gap on Monday definitely made it to where it was a lot weaker than usual. But take a look at this price action. This screams volatility is rising. It just screams it. Whether we go up or down from here, again, volatility is starting to rise again. So again, volatility does a whole bunch of things that we talk about. It puts pressure on, again, the high tech, high beta names, anything speculative, anything that people are moving in and out of fast. Stuff like Tesla had a terrible week last week. But the boring stocks, it's almost like they didn't even notice last week. Here's the Qs, and you can see the Qs is just a lot worse of a chart. We are clearly below all the moving averages. And, I forgot to go through, we have lost half of our gains. And in Fibonacci, when you have a rally and it breaks below the 50% line, it's basically saying that rally is done. It's dead. And so now we're looking at where's the next level of support here? And really, we got to go down to a couple levels here. It just doesn't look good. So I'm looking this week saying very, very likely to go down lower. Darren, what's your call on the markets here?
Yeah, I think we're going to hang out for a little bit. Actually, I think we ultimately do go lower, but I don't think we have. If anything, we're gonna drift lower. I don't think we're going to have any particularly sharp moves. And I have a different take on the volatility. I mean, if you want to go to the VIX right there, you can see we're not getting any spikes. I mean, we're in there between that 22 and 25 range, which is not uncommon. I think there's a lot of complacency in this market, and we've got a lot more room to run to the downside before that volatility spikes back up. I think that people are resigned to the fact that we're probably headed down. I mean, you take a look at other market moving events. I mean, you take a look at Elon Musk making a tender offer for Twitter, and then Vanguard upping their stake in that as well. And then news just came out today that Twitter's board of directors instituted a poison pill. So, I mean, even though you had a tender offer, if you take a look at Twitter, there wasn't a big spike. There's not a lot of faith in anything like that. So I think there's just this. We've said it before. The market is just heavy. I mean, you got big news events that aren't moving individual stocks the way you would think. There's just not a lot of faith that there's a way forward. I mean, it's like there's a blanket over over everybody. So I think we do drift lower. I think I've got a 0 to a -1 in my personal outlook here. So I don't think we have any sharp moves to the downside, but I think some market apathy takes hold, and we just end up being resigned.
I completely agree with that, Darren. And I was about to get to my point, and I agree with you. The problem is this week, we don't have the energy. We don't have the drive to really move lower because there's just not a lot going on right now. So if you take a look at just the news flow coming out, we are going to start to have some earnings. Maybe that could be some sort of catalyst, but we don't really have any economic reports this week. We don't have any Federal Reserve speakers, but we do get the Beige Book on Wednesday. The last 2 months, the Beige Book has come out. It has moved the market lower because people are reading, oh, this Fed is even more hawkish than we thought. I do think that maybe Monday, Tuesday, we tread water, maybe even trade up a little bit. And then I could see that Beige Book pushing some more selling to where we end up flat to down for the week. So that's really my call where we are. Now, technically, we are at I'm going to call it a -1.5. We've broken below moving averages. The moving average hasn't turned down across yet. So we're moving more bearish, but it is what it is. Technically speaking, this is a mildly bearish market. My weekly outlook is also a -1. I think at the end of the week, I think we have 2 or 3 up days in this week, but I think at the end of the week, we've drifted a little bit lower to people who are long they're not going to be happy about that. Because I think there's going to be a few days where it looks like, oh my gosh, I'm going to get saved. And then it's just going to fall right apart. Just like we saw last week. Last week was a great indication of what to expect. Gap up, fall. Run, everyone gets optimistic, fall. I think this is going to continue to happen to the longs that are looking to try to catch some sort of bottom. I think the market's just going to bleed those people away. All right, let's take a look at some individual sectors. And as we've said over the last month or two, the market, has looked sort of choppy. It looked bullish 3 weeks ago. It looks bearish now. The sectors have been crystal clear. There has been no doubt where the sectors are going.
Yeah, I think you're right, Rob. I mean, the story has been in the sectors, and I think it's been in the sectors for the past 2 years, where we talked about this when we called the bottom in March of 2020. We could see individual sectors starting to perk up. It just wasn't being reflected in the broad markets. And I think you really if you're not, we teach the top-down approach to everyone here, and if you're seeing this and you're not a member of the firm, what a lot of people do is they just look at the broad markets and then go straight to the individual stocks. If you're not looking at the individual sectors, and this goes for existing traders too, there's some people that trade specific things. You've got to look at the individual sectors to find out where things are going. Here's what we did last week. I mean, it's pretty much wide across the board. The only things that were up, industrials, materials, and energy, and they were only up mildly. You can see tech, down almost 4% right there. Healthcare didn't fare very, very well either, and communication services was down there as well. So the story's been in the sectors, and you've got to pay attention to that's where the story is. So let's take a look at utilities right there. I still like it. We didn't have a whole lot happen in utilities. We just kind of based right up there. Minimal market action except for Monday, it looks like. But I'm still at a +2 on utilities. I mean, I don't get very bullish on utilities very often, but when everything else looks awful, this is one of the best games in town right now. Take a look at communication services. We had a 0 a couple of weeks ago. I'm at a -1 on comm services. I mean, this one looks good. It doesn't have very far to fall until we hit those March lows right there. So I think this is the story of everything. We're not going to see any massive drops, but I do think we bleed down to that support one, and eventually I think we're going to break through. Real estate was another one that looked pretty good. You can see had a little bit of chop, but largely you can just call that a high base or a bullish flag right there. So I'm at a +2. It held support very, very nicely, even though it was down for the week. I think real estate's still a good buy, especially in a high inflation environment. Industrials, a little less bullish, a lot less bullish on industrials than I was a couple of weeks ago. I'm in a mild -1 on this. It has recovered. It's held in there better than a lot of other sectors has had. This is still above the 50. I would say the 50% mark from the March lows. So I think it's possible that we go back, that we base here or possibly go back up. But until that case, I'm gonna be taking some selective bears in the industrials. On the healthcare, this one still looks pretty good. I mean, it was up there. It pulled back to the 20-period moving average. Now, this was a fairly substantial pullback, but it was so far away you would expect this. It held the 20-period, looking pretty good. I'm at a +2 on healthcare right now. That's not the case with financials, though. Financials, we thought were going to hold in there fairly well, but you can see, I mean, we had a shooting star on Monday, even worse candle on Tuesday, even the up day on Thursday with everyone else. It couldn't get out of its way. We had a very, very small attempt at a rally, closed at the lows on Friday. So I'm definitely at a -2 on financials here. There's not a whole lot that's looking good for me. Consumer is one that I'm at a 0. We got to see where we go. It's held in there. This has a good possibility to bounce, but we're pegged between the 20 and the 50 moving averages right now. I'm very much a show me what we can do. If consumer can get out of that little rut between the 20 and the 50, I'm happy to go bullish until it does. I think it just drifts sideways right now. Tech, this one definitely has a bias to it and is to the downside. You can see I'm at a -2 on tech right there. Once that it briefly went up there, but once that 20-period moving average crosses back over to the downside of the 50, -3, and I think it just gets uglier from there. I mean, take a look at that candle on Friday. Not looking good. Bearish engulfing right there, closed at the lows, and didn't even hold support that it was trying to establish during the week. So there's not a lot of people like tech right now. Basic materials, I'm at a +1. The sector looks good. I think there's some good names out there. You have to be very specific with the individual industrial groups, but I think we've got some upside in basic materials. I do think we hit resistance in the November or the January highs right there. I think that's where we're gonna see a little bit of resistance right there, but I'm happy to see it come back to its 20-period moving average and bounce from there. So I do like materials right now. Energy, this has been looking good for a long, long time at a +2 on energy. You can see that we're making new highs right now. I mean, Friday we had a very, very good day, very narrow range, but I think we got above that resistance, and I think we continue to move up on energy. So a lot of stuff looking good right there. You can see tech and financials looking the worst right there. Industrials and comm services looking a little better, but they're still bearish. Consumers got a 0. Materials is that +1, but look at what we've got in the +2. I mean, this is a change from several weeks ago when nothing looked good. Now we've got individual sectors that are looking good. That's energy, healthcare, real estate, utilities, everything looking bullish right there. So let's take a look at some potential trades right here. First thing in real estate, last week we were talking about Iron Mountain, and we were long Iron Mountain, and it went down 1%. So if you've got some time to wait that trade out, I think you're going to be paid. You're going to be paid for that. It just didn't participate with the pullback in real estate. Let's take a look for this week. We've got realty income. Now you call it a nice high base. You call it a breakout right there. You can see we broke above the January highs right there. Little bit of a slightly worrying candle on Friday. That's okay. I would take a look and see what happens on Monday. This one definitely looks like a good potential long, especially in a nice strong sector. You go out to, I can't believe we're actually talking about going out to May already. You view that May 70.75. If you want to go a little more aggressive, this one looks like it might have some legs. I think that long the June 70, so give yourself a couple months, short that May 75, and that'll give you a month to get up to the 75 area, and then decide what you want to do with it. So this is a little bit longer term than a lot of the diagonals we do. Still looking pretty good. And I think that's probably the way that you want to play it. Last week in communication services, we were short Twilio, and that paid us very, very nicely. Twilio was down 6%. So as you can see, there's a lot of stuff in communication services that is looking good to the short side. And this week we have Baidu, B-I-D-U. This is a Chinese company, a nice low base. It's breaking down. I mean, I would say you could technically say that it broke down on Friday, but a little 3-day base right there, and it just looks like it wants to go. I mean, your target could very well be that 105 mark down there in March. So there's definitely a lot of a decent downside. I mean, that's over 20 points right there. So I'm going to play this one. In this type of market environment, you could very well make the case to go long those May 20th puts, especially with volatility. It's slightly elevated, but it's not that elevated. If the market really falls apart, volatility is going to increase, and that's going to add to the value of those May 135 puts. If you want to play it a little less aggressive, long the May 20th 135 and short the April 22nd next Friday's 125 for a little diagonal put spread right there. So that's probably how I'd want to play it. In healthcare, last week we were long Medtronic, and this one that we're down about 1%. So even on the ones that we've been long that haven't participated, they've only gone down very, very slightly, and I think they've got a good chance to bounce back. This week we're looking at AbbVie. We've played this several times in the last year. A nice bull pullback, a little bit deeper than the 20, but you can see we had a very good candle on Friday right there. While the rest of the market gapped up and slid the whole rest of the day, this gapped down and climbed back probably 2/3 of Thursday's move. So this is looking, there's some strength in there. People want to be long this. So I'm going to be looking out I'm going to play it a little bit short term. I'm going to go long the May 160s. I'm going to short this Friday's 165s against it. So I think we coast up a little bit right there, and then I'll reevaluate on Friday and see what you want to do. If you want to give it a little more time, you go out to April 29th and short those 170s against it. Either trade I think looks good. I'm just going to play it a little bit more, I would say conservatively and short term for this. But then if I like the way it looks, I'll keep those May 160s.
In the industrial sector, one of the few sectors that were up last week, we actually had John Deere last week as a trade, and John Deere had a great week last week, plus 6% on the stock. So definitely like the price action in this. Staying on that theme, let's stay long in industrials. Now look, industrials as a whole, Darren ranked it in a mild -1. Totally agree with that. But there are some things happening inside the sector that when you look inside the sector at all the industry groups, there's a couple things like farm machinery is going crazy. Take a look at a chart on Caterpillar. We did John Deere. Anything farm related in industrials is doing fantastic. Anything defense related in industrials is doing fantastic. What's not doing fantastic is like people that sell elevators and big heating units and stuff like GE sells, that kind of stuff. But one of the little industry groups in the sector that's been weak lately and has all of a sudden shown tremendous strength is the airlines. I am not a huge fan of trading airlines, and whenever I do my scans and I come up with an airline stock, I most of the time just say, you know what, I don't care. I'm just going to go to something else. The strength in this sector was huge last week. And so look, there was a very, very big run. We got all the way down to almost 36 and we closed at 42. I mean, that is just a monster move. We do have some resistance up here. I can't ignore that resistance in the 44, 45 area. But as far as looking for a trade that right here, right now has momentum, look at the volume that came into this. The volume was just a fantastic read on Friday and on Wednesday and Thursday. I like this one. I just have some concerns that at 44, it's going to run in a little bit of a trouble. So this is where I pull out one of my favorite strategies, the good old trusty diagonal call spread. go long the 40s, and I'm going to short this week's 44s. That's going to bring me in some premium. And so if Delta ends up fizzling out and it's out of gas, I'm fine. I'm in a diagonal call spread. I'm going to make money on this trade. And then on Friday, I can look at the trade and say, okay, what do I want to do? Do I want to hold on to these May 20th $40 calls? Do I want to sell the next week's April 29th $44 or $45 calls? So it gives me a lot of patience that I can sit and wait and see what this is going to do. But to me, this sector has got a lot of momentum going into it last week for sure. In financials, last week we had a call on short on Lending Club. For those of you that don't know, Lending Club is one of these non-bank lenders. And I've got a good friend of mine who works pretty high up in the FDIC. That's not a flex at all. I can't get him to do anything for any of you. So, but we always talk about, he is I shouldn't even say what he does. Anyway, he watches over banks to make sure they're solvent and following the rules. We talked about how the banks are actually in really good shape. If you take a look at where we were in 2008 and, the banks, even the big banks, were failing because they were over levered and they had just gone too far. If anyone's worried about that kind of collapse again, you look at the big banks, they're actually doing great. They restructured everything and they've been running a really clean book really since then. However, what that meant was they didn't make loans to people that they didn't want to. They tightened up their credit. So now all their loans are pretty good credit. Where did all that credit go to? Non-bank lenders started appearing where they say, hey, we're not a bank, but we'll lend you money. And through some loopholes, they don't have to get banking licenses. So Lending Club fell 7.5% last week. And we think there's definitely still more to go. We had a target of 10 on that one. So that thing still has about, in our opinion, 15, 20% left to go to the downside. This week, we're going to switch over to the long side in financials. I initially was looking for a short in financials because the sector looks terrible. The sector, other than technology, financials is the worst looking sector out there. The problem is I could not ignore this stock. So I've already got some shorts working in financials. So one of the ways to kind of hedge out that risk is take a long and a strong stock in financials. And this is Unum. They are an insurance company. And you can see we had a run, a fall, breakout, a retest, and it held nicely. This is just a really nice bullish pattern here. The question is, where is it going? This thing only has monthly options, so we're going to have to go all the way out to May. We don't have the ability to play a diagonal call spread here unless you were to go to the June, May. So I'm just looking at straight vertical, very simple trade, 32 to 34. This is going to cost me 80, 85 cents. I'm going to have $1.20, $1.15 of reward, and that's the trade. It's a very simple trade here on this one. If you don't have any exposure in financials, I'd actually recommend that you go find a good short in financials. I think that's going to actually be an easier trade because the sector looks terrible, but this one was just too good to ignore for me.
Yeah, it's funny when you and I started, Rob, monthly options were the only thing that was available to us. And I remember it was such a big thing when we started getting weeklies, and then more people got the weeklies. How annoying is it when you find something you want to play, but it still only has the monthlies? It's like you're trading, in the Stone Age when you do that. But
that is Stone Age trading trade the market for sure. That is Stone Age. Stone Age. Okay, maybe Iron Age, maybe not Stone Age. Bronze Age, maybe.
It's definitely a throwback. So consumer, last week we had Hostess, and that we were long that. It was up 1%. So we're waiting for the nice good run in Hostess, but we're happy to hold on to that position. This week in consumer, we're looking at Newell Rubbermaid, NWL, and we're going to play this one sideways. We have been doing a lot of directional stuff, but sometimes it's just good if you can see, and this is the great thing about trading options, if you can see something is going sideways, that's dead money if you're playing the underlying. But with options, you've got the opportunity to play, to let time decay work for you. So this one's going to be a 21, 23, 25 call butterfly right here. You can play it with the puts. It really doesn't matter. But right there, just expecting a slow drift up to that 23 area, not expecting a whole lot going out for the month. Now, we don't recommend holding butterflies, especially targeted ones that are slightly targeted like this. We don't recommend holding them until expiration, especially not a month out. So as soon as it gets up, if I put this trade on Monday, as soon as it gets up to that 23 area in a week, 2 weeks, or whatever, I'm going to probably take the entire position down. At the very least, we'd recommend that you take half your position down and keep the profit there. If you want to let it run, the rest run to expiration, go right ahead. But just keep that in mind when you're playing stuff like this that's targeted. If this was a 1 week trade, I'd probably look to let it run until expiration. But it's not, and it's targeted. So just beware on position management on that one. And technology, last week we had Shopify. We were short, and Shopify fell 4%. So we're happy to hold on to that position right now as well. This week in tech, we're looking at AMD, Advanced Micro Devices, and this is going to be definitely the downside here. I mean, this had support at the 100 area. It hit it 3 times and finally broke through. I mean, we're down another 7% from that support point right there. So I definitely think we've got some. I'm going to go out there, and I'm going to, this is another one. I'm looking at those May 100 puts. They're nice in the money. Gives me a month to work it out. If you don't want to be that aggressive, I would probably be taking a look at the April, next Friday's 90-95 bear call spread. You're probably going to pull about a $2.50 credit out of that one, and then you're going to have another $2.50 in risk, but it is stated positive for you. Not looking, I mean, you're not asking a whole lot in a week. That's why I'd like going out in those in the May time frame. But if you want to play it shorter term, definitely look at that bear call spread.
Last week in materials, we talked about Corteva, CTVA to the long side, and it was up 3%. Definitely a decent week, and we think that stock likely has more to it. This week, I also like materials, Darren, but I've got a lot of material stuff. I've got a lot of energy stuff, and whenever I have a lot of exposure, I always like to say, hey, let me hedge that out a little bit, because let me go find something in materials that isn't working. Because let's say the materials sector turns around, and let's say it has a bad week over the next week or two. If I pick up a short in that, I'm going to make money on that short, and my longs that are working are likely going to come back down to break even or maybe even small losses. It's going to hedge that out. And the best thing ever is when you are right on your longs. So let's say Corteva keeps moving higher, and this Huntsman keeps moving lower, you're going to make money on 2 stocks, both long and short, in the same sector. Let's talk about this pattern here, because this was in a really clear uptrend with all the other chemical stocks, and just a really nice run. We did dip below the 50 here, but we recovered in just this gap here. I don't know what happened. I don't care what happened. I don't need to know what happened. But that was kind of the kiss of death for this. It tried to rally. It failed miserably once it got back up to these moving averages. And look at this, the volume on that rally, really pathetic. And then look at the volume on the rundown. And then look at the volume on this rally here. So when you take a look at the technicals, the candles, and with the volume, you can see that on the up days, there's hardly anyone in there. And it's just because the sellers got exhausted. And so because there weren't as many sellers because they were exhausted, any small amount of buyers can come in and move this up. So we have a nice bear rally here from the 34, got all the way up to the 35, and you can see Friday's candle was just nasty. So if we do break below the support, which I think we are, next stop is going to be 33, and then below that we're looking at 31.50. So let's take a look at some possible trades here. I like the May 20th 32.35 bear call spread. It's a pretty simple trade. I'm looking at 32, 35. I'm probably going to get $1.70, $1.80 on a credit, which means I've got $1.20 of risk if I get $1.80. So I can put on a trade, $1.20 of risk. This thing can move wherever it wants. This thing can rocket up to 42. I don't care. I've quantified my risk at $1.20 with using a call spread. And if it does fall, like I think it's going to, and it falls anywhere below 32, that's going to be a nice $1.80 profit on this. So I do like taking a little bit of a short here in materials, but I'm going to say the same thing that I said with financials. If you don't have enough exposure materials, I think you should go look for a long before you take a look at a short here. And ending with energy, last week we had Antero Resources up 6% last week, so we'll let that one run as well. Here we have another bull, Chevron. When I was first getting into trading, maybe my first 2 or 3 years, if you showed me this stock chart, this would scare me. And there's no way I could ever buy a stock like this. I could never buy a stock that had gone up this much. Gone from 120 up to 170. Are you crazy? You're going to buy it now? Now I've been doing this long enough. I salivate when I see this. I want you to take a look at the green candles versus red candles over the past 3 to 4 months. It's got to be 4 or 5 to 1 green candles. And even in pullbacks, look at this. Even in pullbacks, it's mostly green candles. It's mostly green candles in pullbacks. This is just being bought. It's just being bought hand over fist. And you can see we broke out and, yes, there are some long upper shadows here. We got to push through. I don't see any reason why we can't push through these. This is where, again, I love to pull out my handy diagonal call spread. I don't know what's going to happen this week, but I think over the next couple weeks, this thing's going to have a nice run. So I can do a 165, 175, and get some positive theta here. And let's say this thing just sits here and does nothing for a week. Guess what? I'm happy. I make money on that trade, and I can look at it on Friday and say, hey, let me dump the whole thing for a small gain, or let me hold on to these 165 calls, or let me sell the next week's 175 call again and do this whole thing again. If it does take off and run, then yes, anything above 175 you don't get. And that is always the bad part about the diagonal call spread, is that you are selling off your upside potential. But we love these trades, especially when we do them short term, where we just wait a week, reevaluate. Okay, let's dump that one. Let's move the money somewhere else. We love this strategy here. If there's any trades you want to talk about, always go to our Maverick forum in our members area, and you can discuss those trades with other traders and get some nice ideas. We always love to see our traders working together and conversing together. So to wrap this up, the market is more bearish and bullish. We are not like ultra bearish like we were 2 months ago. We're like getting ready to get that bearish, but right now we're not, because the technicals are just not there yet. We do think there's still going to be that choppy 1 day down, 1 day up, 1 day down. And that's really tough for new traders. And I had someone ask me a couple of months ago, Rob, what's the one thing that gets new traders? Like, what's the one thing they screw up? Or what's the one thing that gets them? I said, volatility. Volatility causes you to get knocked out of positions you should stay into. It causes you to react to things that you shouldn't react to. Volatility is what gets you. So this is where we always say, either be in higher volatility, be shorter term or longer term. Don't be in that 2 week area. Two weeks out is tough. I would rather be like 2 days out, 2 or 3 days out, or like 2 months out. I think that's where you want to be here, because in choppy trading, you get lots of chop. You get these big runs and falls and big runs and falls, just like last week, just neurotic 1 to 2% moves every single day. We're likely to continue to see that. But overall, as Darren said, and I agree with, we drift lower. We drift lower until we get to a point where people say, oh crap, it's happening again. Then we get the flush, and then we probably get the bottom. As always, proper position sizing, that is the key to trading long-term successfully. Thank you so much for joining me. Everyone have a great holiday weekend. Goodbye, everyone.
Good trading, everyone.